Welcome to Total Convexity, a weekly financial podcast that caters to professional finance individuals, high net worth investors, family offices, and other sophisticated financial professionals. Join our hosts, hedge fund manager Jim Wang and Henrik Neuhaus, as they explore the interconnected world of global macroeconomics, central banks, and capital markets. Comprehending the intricate web of global macroeconomics, central bank policies, and capital markets isn't just an option, it's a necessity. Whether you're a chief investment officer, financial analyst, entrepreneur, or simply someone curious about how the global economy and capital markets function, this podcast serves as your compass through the intricacies of the global financial landscape. In each episode, we will delve deep into the influential factors shaping our world, from global economic trends and central bank policies to capital markets and trading strategies. We will demystify financial jargon, clarify complex numerical data, and provide you with insights from experts in the field.
Total Convexity episode 7 is recorded on the 9th of November, 2023. I'm your host, Henrik Neuhaus. Joining me is my co-host, Jim Wang. I'm glad to return with episode 7 of our podcast series. In the first episode, we discussed our investment and analytical framework, and we recommend new listeners to start out by reviewing our first episode, as the explanation of our framework lays the foundation for subsequent episodes. Since then, we have discussed interest rates, the US dollar cycle, gold, fiscal and monetary policies, and in our previous episode, provided an update on liquidity. Jim, what would you like to discuss this week?
Hey everyone, I'm glad to return to the new episode. By the way, today is November the 10th. I know time goes by fast. Given the recent volatilities in the interest rate market, and also the synchronized movement of stock and bonds, I think maybe it's a good idea for us to discuss the correlation between interest rate and bond, interest rate and the stocks. What do you think, Henrik?
Absolutely. Yes, that's a great idea. Now, correlation is a statistical measure that expresses the extent to which two variables are linearly related, how they just linearly tend to move together. Return correlations between asset classes hold the key to the benefits of diversification across different asset classes. We also have that, according to modern portfolio theory, holding the market portfolio gives an investor the best possible risk-return trade-off over a longer time period. And we now have the explanation for why the traditional 60-40 portfolio with different variations and the more levered versions of risk parity have gained such popularity. I remember that back in 2020, after the start of the pandemic, Jim, you wrote that bonds would fail to provide diversification to stocks, making the traditional 60-40 portfolio and risk parity strategies poor choices at the time. Fast forward to today, and now everyone seems to agree with you, and it is received wisdom that the 60-40 and/or risk parity strategies are a thing of the past. Of course, and this is worth remembering, in the past 35 years or so, leading up to the beginning of the pandemic, the bond market experienced the secular trend of declining yields. So for two generations of investors, the 60-40 portfolio must have seemed like a universal constant. Are you trying to claim victory today, Jim?
Yeah. So I think victory lap doesn't come often, right? But joking aside, I would say that at the time, during the pandemic time period when the interest rate hit the rock bottom, and I think the argument that bond will cease to be the diversification effect was straightforward. It's more mathematical, because when you hit 0%, and how much you can go down, right? And obviously, we also have a little bit longer view beyond beyond the numerical kind of level of 0%, in the sense that we can foresee that inflation would become a problem because of the large fiscal stimulus, and more importantly, they all monetized by the central bank. And when that happens, that traditional 60 and 40 portfolio and the risk parity that rely on the correlation between bond and stock will not work well. And but now I actually think that that in the future, in the next 1 to 2 years, the bond could return to be kind of a diversifier for the traditional portfolio again. And it may not necessarily be in the long run, but in the next 1 to 2 years, I think it can become a diversifier.
Okay, very interesting. So why do you really expect bonds to provide this, to be this diversifier in the future? And why, and more specifically, why only in the next 1 to 2 years?
Yeah, so I think in order to understand kind of my changing, so remember during the pandemic time period, I said that the bond will cease to be diversifier. Actually, they would become a risk for the stocks and the credit. And now I'm changing my mind, and I also assign a specific time horizon to that. So I think to understand that, kind of this forecast probably is better to understand the thinking behind that and the framework that I use. First of all, when we talk about correlation, Henrik, it's basically a statistical measurement, right? And depending how you measure it, the result will be drastically different. Say, for example, you can use daily time series, right? And for the same two asset classes, right? To construct a correlation, right? You can also use quarterly correlation, quarterly returns of these two, asset classes. You can also use yearly if your time horizon is very long. I mean, use very like 12-year rolling window. The correlation will be drastically different. Okay, so I think that's the first point. Second point here is that correlation is not a constant number. It changes. Okay, depending on the time horizon you measure. Sometimes it's positive, sometimes it can be negative, right? And also the time horizon you measure is very important, right? So I can give you two time period. One time period, they have a positive correlation, time period A. And then in time period B, they have a negative correlation. Now, if I do a regression for time period A and time period B together, the result is uncorrelated. But actually, the uncorrelated nature of that number, they hide the fact that for some period, some extended period, they're positive. For some extended period, they are negative. Now, this will become very confusing and seems to be random. But in the end, the correlation between equity and bond. There is a real economic relationship between them. So like right now, everybody's saying, oh, look at a bond. They failed to protect the equity in the downside. I think that statement is a wrong statement, because the risk to the stock market is actually coming from the interest rate. It is because of the interest rate that we experience the weakness of the stock market. Okay, and that's on the current stage. And that's why we have this synchronized movement of a stock and a bond. And that can change. And we expect actually that change as well. So I think understanding the real economic relationship between bond and equity is very important, rather than just look at the statistic, past measurement of past correlation for a specific period of time.
Okay. So did you mind going a little bit more into the mechanics of this relationship between equity and bond returns?
That's right. We can get there. But Henrik, as you know, the discounted cash flow model is basically the foundation to evaluate any financial asset, right? as long as they generate cash flow, right? So in this case, the discount rate, depending on what you are discounting, right? So the treasury bond will be the interest rate associated with whatever maturity, right? And the credit will add, risk-free rate plus or treasury rate plus a credit spread. The equity, the discount rate will be the treasury rate, treasury yield, or risk-free yield plus a equity risk premium. And therefore, rising interest rate is basically lift the discount rate across all the asset classes. In this sense, inherently speaking, this will result in lower net present values of all financial assets, everything else equal. So from that perspective, the relationship, the return relationship between equity and bond should inherently be positive. Okay. However, everything else is not equal because we have a cash flow component. And interestingly, the cash flow typically decline during the recession time period. And the interest rate typically decline because the Fed typically will ease the monetary policy, lower the interest rate during the recession. Therefore, that the relationship between them become negative. Okay, so because during the expansion time period, cash flow of the corporate will accelerate. However, at that time, the Fed will choose to raise the interest rate, right? And at the time, the stock and the bond, the relationship will become negative. So understanding by observing the correlation between equity and bond, and you can tell where we are in terms of the market, kind of a regime we are in, and can anticipate where we are heading. Does that make sense to you, Henry?
Yes, it does. Now, you have previously mentioned that correlations are an inherent part of your market cycle framework. So could you explain a little bit how that works and what the linkages are?
Yeah. So I kind of a hint on that when we mentioned that, the kind of the discount cash flow. Basically, you have a discount rate and the cash flow, right? And the inverse of discount rate is actually basically is the multiple, right? So you can see different things about that. In order to understand that, so I pull here another 2x2 grid. Okay, so you can see here, I have basically interest rate hiking cycle and the interest rate easing cycle. Okay, and on the interest hiking cycle, I have a positive correlation between equity and bond, and then negative correlation between equity and bond. In the easing cycle, I also have a positive correlation and a negative correlation, right? So this will give you 4 quadrants. In quadrant 1, I call it the bull convergence. That's basically you have an easing cycle, and then you have a positive correlation. And then in quadrant 2, you have a hiking interest rate cycle, and then you have a positive correlation as well. In quadrant 3, you have a hiking cycle and a negative correlation. I call it a bear divergence. And then finally, we have an easing cycle and a negative correlation, and we call it a bull divergence. So we can fit our market cycle framework here. We can also fit our liquidity framework here, fiscal and monetary policy here, and a lot of things here in this grid. So let me explain. Where do we start? Maybe we can start with hiking cycle, right? So we have a very drastic hiking cycle. So let's see, the hiking cycle typically will start when the economic expansion gain hold, right? When the economic expansion was, economic started to expand out of recession, corporate earnings start to pick up, right? And then during that time, interest rate start to rise. Although Fed still kept the Fed fund rate stable, but the market anticipate the Fed one day will hike interest rate. So longer dated rates will start to rise, right? And because we are just right off the recession, corporate earnings are expected to be strong. So the stock price will go higher, and the bond price, right, actually go lower. And that is basically negative correlation between them. And this is in the early market expansion. And this will last all the way into the mid of expansion, right? Now, once we head into late market expansion time period, the corporate earnings expectations start to basically peter out, right? At the same time, the interest rate have increased a lot as passage of time. And the negative correlation will start, the negative correlation between them will start to diminish. Okay, so they are less negative anymore, meaning the rising interest rate will have more impact negatively on the stock price. As we mentioned, right, that not, so as we mentioned in the past, that does not necessarily result in the negative kind of the stock price once the Fed started the hiking interest rate, because economy, the earnings can still grow, and can still handle the rising of the interest rate, right? And then once we arrived at a point, right? So we say correlation will be less negative, right? And gradually they will transition into a positive regime. And why? That's during the time, once the monetary policy become very restrictive, okay, and then the interest rate will start to fall, okay. So that will come to the easing cycle, right? And during that time, the corporate earnings are declining, and we have recession. And at the very beginning, the interest rate, the reducing of the interest rate is slow. The magnitude is small. It's not enough to offset the decline of the earnings, right? So the stock will drop, okay? And that's the time stock goes down, okay? And the interest rate goes lower, or bond price goes higher, right? So that we are in the bull divergence space. And during that time, the stock will provide diversification for the bond, and they are negatively correlated. Okay, so once the Fed cut the interest rate deep enough into after Fed have cut the interest rate by a significant amount, and after that we have after we have done that for a long period of time, and at the same time the financial kind of excess were corrected, earnings have declined a lot of excess capacity have been eliminated. So the stock cash flow arrive, the expected cash flow basically are about to at a turning point, right? And then the negative so remember, we're talking about positive correlation, right? So this positive correlation will start to diminish. Okay, in other words, the driver is more going to be the expected earnings growth, the expected economic growth, rather than the discount rate. And then we have this cycle again, repeat again. So I would say you can basically map it out. So by applying that framework where we are right now, I would say we are at a hiking cycle, right? Remember in the at the very 20 rising interest rate. Interest started right in 2021, and the stock price go higher, and the bond yield go higher. So they are basically negative correlated, and so there's a bear divergence kind of a regime. And then later on, the discount rate, once they have arrived at a certain level, they become very restrictive, and that dominate. And at the same time, the earnings kind of no longer become a dominant driving force. So we're in a quadrant 2, basically is driven by the interest rate. So it's convert, they move in the same time, in the same direction, because the interest rate is dominant driver for the asset classes, for the asset. We're going to head into, but we think that we are about to head into the next regime, which basically will result in a recession. And during that time, we're going to have an easing cycle again. And so bond will rally, and the stock will probably have some problem. And then bond will provide diversification again. So, and then this cycle rings and repeat. I'm not quite sure if I explained this, does that make sense to you, Henrik?
Yeah, it does. Yes, it ties. Yes, of course it does. But okay.
By the way, I forgot to mention this, Henrik. Sorry to interrupt you here. Is that you remember people always say good news is sometimes there is a good economic news release,
sure.
And people say good news is good news, right?
Yeah.
And that's basically the economic was driving right out of the recession. And the way you tell is whatever good news come out, and the market have a big rally. So that is good news is good news. And sometimes good news is bad news, and that's typically towards the very end, the monetary policy become restrictive. Is at a tilting point where whatever good news come out, and it will only enforce where people know that good news is not sustainable, and at the same time, whatever good news will result in the higher discount rate, and therefore good news become bad news, right? And so that's towards more kind of a late stage, right? Conversely, bad news can become a good news, and that is typically, basically whatever bad news, and people expect central bank will ease more, right? And that is basically a easy way to say, kind of explain some kind of a relationship between this as well.
Okay, right. Now, obviously, then during a high inflation environment, bond and equity returns tend to be positively correlated, and positively correlated, of course, could also be a reflection of both having negative returns, right? Now, I'm still trying to understand what happened to my portfolio here in the recent past. So could you become a bit more granular and explain my pain to me?
Yeah, so we're talking about inflation, right? So during the high inflation time period, why the bond and the equity, the correlation, will turn. So when I talk about during the recession, the interest rate tends to fall, and that's because the Fed lowered the interest rate, right? And that's why during the recessions, right? So the correlation between them is negative. So the bond is diversified. Although equity goes down, bond will rally. But then we have to ask ourselves the question: why the Fed lowered the interest rate? I mean, obviously it's because of recession. Now we know Fed have a dual mandate. One is the inflation, the other is growth. So if inflation is a problem, although growth is a problem, but inflation is a bigger problem. So in that case, the Fed cannot lower the interest rate. Now you get a problem that the growth slows down, that will impact your cash flow. And the inflation is high, that the Fed cannot lower the interest rate. And sometimes they can actually need to hike the interest rate. Now the relationship between them is going to be broken, because it's going to be more driven by the desire to fight the inflation. And that will move, especially that is true when the inflation is high and the growth is slow. Does that make sense to you?
Yeah, yes, it does. It does. So, okay, now we recently talked about our liquidity framework and so on. So could you explain, for example, how the return correlation between bonds and equities ties in with the liquidity framework?
Yes. So when we explain this relationship between them, again, we are assuming, right, that the typical central bank reaction functions, right, and the typical inflation and the growth kind of behaviors, right, during the different economic regime, right, and the liquidity is different, is another component that can change this dynamic, okay, and typically speaking, like we talk about, when there is a liquidity increase, big liquidity increase, okay, then basically rising liquidity lift all boats. So that's positive for the aggregate level of the financial market. So that'll push up all the financial asset classes. Okay, and when so the correlation is positive, okay, and it's for the asset price effect is also positive. Okay, and that liquidity can come from a lot of places. It can, we explained actually after Asian financial crisis, U.S. benefited from the liquidity from the reverse reserve managers, right? That want to hold the reserve asset in U.S. dollars, right? And then later on was the QE Fed, and also when the Japan was doing QE and Europe was doing QE, and all the money actually came to the U.S. So we have basically have a 1 decade and 2 decades of liquidity, and obviously the supernova was in the during the pandemic time period, right? Now when the liquidity come out of the market, right, and it's basically it will have a pressure across all the financial asset classes. Okay, so all the financial asset classes will suffer. So in that case, the correlation, it will increase the correlation between different asset classes, equity and bond. At the same time, and obviously they are negative for the asset price. So they are negative asset price, and they will fall together, and that's the case that we are in today. All right. Now that's generalized for the entire. We are talking about for the overall. Assuming everything else is equal. However, how the growth and the inflation come into play. Like we said, the distribution of this pressure will be distributed across different asset classes depending on their relative valuation, right? And their relative valuation, their valuation relative to future, kind of a growth and inflation pictures. And that's why during the during the QE time period, every time Fed does the QE, right, bond yield actually sell off, and the stock price actually rally. That's because we have a economic acceleration after each liquidity kind of injection. However, without QE, you can argue that the yield would rise much higher than otherwise would be. Okay, and with QE, the interest rate we were able to push into the floor, right? So by applying the similar kind of cause and effect to today, what we can see here is that the liquidity is being drained, and that have a pressure for all the the bond and equity, and to a certain point, once we have a recession, once the bond price reach to a certain level, now you and I can argue what is attractive for the risk investors who liquidate their stocks and the fund credit. And during that time, bond may actually rally. Okay, that's because the money will come out of the bond and credit, and during the economic recession, despite of the liquidity squeeze. And obviously, if you do not have a liquidity drain, they will rally much more. With the liquidity squeeze, they may still rally, but rally moderately, right? And if during the recession and the liquidity further tightened, bond may not rally, and in that case, stock will go down a lot more, right? So I think this is not the dynamic that we are watching. Now we do not know exact level, right? What we can observe is when the stock price will react to the rising bond market, and when the bond market will react to the reaction of a stock market. That sounds convoluted, but basically we want to see if the interest rate will result in stock price higher or lower. And if the rising interest rate will result in stock price lower, and that means that the predominant driver still is the discount rate, right? Now, if the stock price goes low enough, and the bond price does not go, the bond yield does not go higher anymore, and that tells us that there is money that is flowing out of the stock and go to the bond market. Now we have to be clear, we have not seen that yet. Okay, the regime that we are in right now is predominantly still driven by the interest rate. Basically, rising interest rate, everything sell off. Lowering the interest rate, everything rally. And until we get into recession, where economy become a dominant factor again. So that's how we tie kind of liquidity framework into this. Now, if the liquidity is not the predominant factors, okay, then the correlation and between equity and bond, we can apply the framework that I showed in this grid.
Okay.
Okay.
Right. Okay. That makes sense. Now, okay, so we now spent quite some time discussing these correlations, the return correlations between bonds and equities. Now, could you give us some pointers to very practical uses of these insights?
Yeah, so I think the first thing that we want to realize that basically the correlation is not just a statistical number, and understanding what time horizon you use, and the frequency of the data that you use, and you come up with different numbers, but it can help us to understand what is the predominant driver of the asset prices at a particular moment of time. It can inform us the stage of the market cycle, market regime. And by doing that, it also helps us anticipate the change of correlation, right? Because the change of correlation is very important for the asset allocation. So that is very helpful. And of course, if you are derivative traders and you structure different cross asset classes, or within even asset classes, you're dispersion traders for different sectors of the stocks, and they react differently to the different interest rate environment and the growth environment, and you can structure dispersion trade and etc. So whether you are macro, hedge fund manager, or whether you are asset allocators, and I think your first job is to understand, to use the correlation observed in the market in the past to understand where we are right now, and then you anticipate what kind of a correlation that can change in the future, anticipate that, and then finally apply that based on the instrument that you have, the mandate that you have, and make informed decisions. Does it make sense to you, Henrik?
Yes, it does. Okay. Yeah. Thank you, Jim. This was a lot. This was good. So I think we now come to the end of episode 7 of Total Convexity. And let's have some concluding points. Now, the return correlation between bonds and equities flows from an inherent economic relationship between these two asset classes. By observing, that is, measuring the correlation between bonds and equities and how this measure changes over time, we can gain insights into the stage of the market cycle we are in, gain a better grasp of the driving forces of the capital markets, and therefore better understand the workings of the current market regime. By anticipating and forecasting the next stage of the markets and the economic regime, one can make informed guesses about the coming correlation between bonds and equities, something which, of course, can be very useful for portfolio construction and risk management, also for asset allocators. And obviously, one can also structure derivative trades to capitalize on likely correlation changes in coming economic regimes. As always, of course, the world is full of surprises, but at least we have a logical and internally consistent way to think about possible and likely future changes so that we can position ourselves accordingly. That's what I got out of this, Joe.
Yeah, Henrik, you summarize much better than I do. Let's make this podcast short and tell us where listeners can follow us, Henrik.
Sure. So you can always follow us by looking up or searching for Total Convexity in your favorite podcast app. or via YouTube. And once you have found us, please don't forget to click on the subscription button so that you will be automatically notified when a new episode becomes available. You can also follow us on X, where we have the handle @TotalConvexity. And you can always email us at totalconvexity@gmail.com. Finally, you can follow our insights on Substack at totalconvexity.substack.com. We promise never to spam you, to push goods, to advertise, or do any other type of marketing. All we want to do is to have fun and to give you our honest take on the markets, rightly or wrongly. And we will try and make it short and sweet. Anything else, Jim?
No, that's it. So thank you, everyone. If you like this podcast, we would appreciate if you can pass along to anyone who may be interested. This concludes the 7th episode of our podcast, Total Convexity. See you next time.
Disclaimer. The information provided in this podcast is for general informational purposes only and should not be considered as financial advice. Consult with a qualified financial professional before making any financial decisions. All investments involve risks. There are no guarantees of profits, and investments may incur losses. The contents discussed in this podcast is not a recommendation for any specific investment. Past performance does not predict future results. The opinions expressed by guests on this podcast are their own and may not necessarily reflect the views of the hosts or affiliated parties. The podcast host and guests may have financial interests in companies or products discussed, and listeners should be aware that the opinions expressed by guests and their hosts may reflect biases. We strive for accuracy, but financial information can change rapidly. The content may not always be up to date or complete, so verify information independently. This podcast does not offer legal or regulatory advice, and listeners are responsible for ensuring that their financial decisions comply with applicable laws and regulations. Mentions of specific financial products or services do not constitute endorsements. Perform your due diligence before engaging with any financial offering. Listeners are fully responsible for their financial decisions, and the podcast's guests, hosts, and affiliated entities are not liable for any financial losses resulting from actions taken based on the provided contents.